Why should I pay to borrow my own money? Well, you shouldn't, but you always do, unless you use this strategy. This question doesn't really come up all that often, but I was reminded that it does come up occasionally because of an event that my wife's family is very involved in today. You see, a relative is having a ceremony for their promotion at work. Now, that has nothing to do with our discussion, but the person being promoted is why I was reminded of this particular question. You see, this relative is actually quite intelligent and he is financially astute in the traditional sense. That is why I was really kind of shocked that he just couldn't get his head wrapped around the infinite banking strategy. See, I explained it to him and made it as clear as I could, but he got stuck on the idea of borrowing his own money. Why should I borrow my own money and pay interest? It's my money. Aloha. I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy. And I'm also the marketing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in infinite banking concept and the tax-free cash growth warehouse finance strategy. Now, if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. Now, I know this strategy is often difficult for people to understand and accept because it's so different from all other financial tools. Nowhere else can you save money in a guaranteed, safe, high compounding, tax-free interest environment and have completely liquid access to it without triggering a taxable event and without interrupting the growth with high compounding tax-free interest. Yeah. Yeah. That's the simplest way to describe it. And then, of course, the liquid access without triggering tax needs to be explained. And the way that can be done is by leveraging the cash value of the account by means of a policy loan. Loans are not taxable. But if you take an actual withdrawal or partial surrender, part of that money may be taxable. And of course, if you actually withdraw money from the account, it will no longer be earning interest in the account. So it's the leveraging by means of policy loans that becomes the stumbling block. Sometimes, as with the relative I mentioned earlier, policy loan is heard, and then everything else just flies out into the stratosphere unheard and uncomprehended. The idea that you borrow your own money when taking a policy loan is another misconception that seems to be hard to get past. And unfortunately, that idea is reinforced by most of all the books that have ever been written about infinite banking concept, starting with Nelson Nash's books. The truth is, when you take a policy loan, you are not borrowing your own money. You're leveraging your money, using it as collateral for the loan. The policy loans are granted by the insurance company, and it's the insurance company's money that you are taking as a loan. That's why the idea promoted by Nash and most other writers on the strategy are misleading. They also say that when you repay the policy loans, you pay yourself the interest that you would otherwise pay to a bank or other lender. That's not the case at all. Here's how it actually works. I'm going to see if I can share this illustration with you. Here we go. Hope you can see this. Okay. Now, so, okay, here's the insurance company, and they have a lot of money. They have a whole lot of money. And here's your account over here, and with the insurance company and the money in your account. Okay. So when you take a policy loan, that money comes from the insurance company. Policy loan, the insurance company goes to you. It's not coming out of your account. Your account and the money in your account stays right there being protected by the insurance company and earning that high compounding tax-free interest. Because your money is collateral for the loan, you aren't locked into a repayment schedule as you are with banks and other lenders. You don't even have to pay it back at all. The insurance company is holding the money in your account, so they aren't in danger of losing the money they lent to you. Okay, I'm going to stop. I'm going to cut this thing here. Okay, there we go. I'm back. So if you never pay back the loan, the insurance company will eventually take their loan money back out of the money reserved for the death benefit of your policy when it comes time to pay that out. So also, you don't pay the interest on the policy loans to yourself. The interest charged and that you pay on the loan goes directly to the insurance company. That's where the loan came from. That's who's charging the interest, and that's who's getting the interest you pay. Okay. What's really great about that is when your account is with the right insurance company, the interest you're charged on the policy loan is, first of all, simple interest, while the interest earned on your cash value is compounding interest. And the loan interest is at a lower rate than what your cash value is earning. Now, at the beginning of this video, I said that you always do pay for borrowing your money or using your money, unless you're using this infinite banking tax-free cash growth warehouse strategy. What do I mean by that? Well, there are other accounts where you can borrow your money out of the account, such as a 401k. In that scenario, you're actually taking money from your account. So that money stops working for you, if in fact it is actually working for you and not against you. And you are required to pay that loan on a monthly schedule, and you're charged interest on top of that. But even if you aren't borrowing your money out of an account, when you pay cash for anything, you're also paying the opportunity cost on the money. That is, you lose the opportunity to earn interest on that money you spend. And so essentially, you're paying the interest that you could have earned on that money when you spent it. When you use the infinite banking tax-free cash growth warehouse strategy and take a policy loan that leverages your cash value, your money is continuing to earn compounding interest at a higher rate than the simple interest you're being charged for the loan. And you're saving the opportunity cost of paying cash. So when you leverage your cash value in your tax-free cash growth warehouse account, you are not borrowing your own money. You're just using it as collateral. And the whole time you have that loan out, your money is earning higher interest than the interest being charged for the loan. The loan interest is simple interest, and the interest you're earning is compounding, tax-free, and you save the opportunity cost of paying cash. So that's a win, 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 win for you. All right, so if you found this to be helpful, please like this video, and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below here. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, we welcome you to do that. The link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.